The broadcast is now starting. All attendees are in listen-only mode.
Hello, everybody. I know we still got some people listening in. Thanks for joining us today. Really happy that we got such great attendance between Han Lozier and Foundation Software and Intellis, all working together to bring you guys some good information here. I know information is of the essence, especially with everything going on right now. My name is Eric Vittardi from Foundation Software. We're going to be joined here shortly, very fortunately, by some members from Han Lozier and as well as Intellis. So a really good group of speakers today. Going to be some good information to kind of help everybody navigate through unprecedented times more than anything. So a couple of logistics things before we get going. We're doing this live, so there will be a recording following this. You guys all get signed up. You'll get an email at the end of the it'll let you know that it'll give you the whole thing coming backwards. You'll see everything as it is. If you have questions, type them in the sidebar. I will monitor them near the end, and we'll kind of navigate them to the appropriate parties. We'll get you guys these questions because I know there's going to be a lot of them with the topics we're covering today. And then I would invite all of you guys to join us next Wednesday and the following Wednesday. So that'll be April 29th and May 6th. If you guys are able to join us on those two, we'll have some additional information. The topics are going to change a little bit every week, but be sure to join us if you guys got good information out of this, and we'd love to have you. So thanks everyone for joining. Thank you, Han Lozier. Thank you for Intellis. And we hope you guys get some good information out of this. And from there, I'll let kind of the stars of the show introduce themselves. Maybe I'll kick it over to you, John Paul, and give a quick introduction.
Yeah. Hi, good afternoon, everyone. My name is John Paul Lucci. I am the co-chair of the corporate transaction group here at Han Lozier and a member of the construction group, and excited to provide some information about this valuable program to everybody. So welcome. Thank you. Suhas?
Hi, this is Suhas Shah. I'm a partner at Intellis Advisors LLC, and our firm specializes in construction accounting and construction taxation, and all the financial services related to construction industry. We are based out of Maryland. Thank you.
I'm Ivan Golden. I'm a partner with Han Lozier. I'm based in the Chicago office, and in more normal times, my practice is focused on tax and corporate issues. The last several weeks, it's been focused pretty exclusively on Paycheck Protection Plan loans and other aspects of the relief for the COVID-19 pandemic. So if we want to advance the slides, I think we can get started. I think I'm going to primarily run through the slides, and then my colleagues are going to provide some commentary on issues that they're seeing either from clients or their own interactions with some of these different provisions. I wanted to just start by noting, many of you may have seen that just yesterday, Congress voted to appropriate an additional $310 billion to this program. I read yesterday, and I can't speak to whether or not this is necessarily true, but I did read yesterday that a lot of that $310 billion may already be spoken for with loans that were, in the pipeline when funding ran out initially. So it sort of remains to be seen, how many additional businesses are going to be able to obtain loans under the program with that additional appropriation. The other thing to note there is that while there is additional money for the program, and while approximately $60 billion was set aside specifically for lending by smaller banks, community banks, credit unions, those kinds of institutions, there were no substantive changes to the rules of the program. So all of the PPP rules as they were remain the same. Why don't we advance a couple of slides, if you would. Let's go. So I'm going to start by talking about how PPP loan funds can be used. Let's go next slide, please. And I'll say that, so there's limited purposes for which these loan funds can be used, not only if you're concerned about forgiveness, but just in general. And so basically it's limited to payroll costs, which we'll talk about in a little bit in terms of what qualifies as payroll costs, rent payments, utility payments, mortgage interest, and then interest payments on other debt that was incurred before February 15th, 2020, as well as refinancing an economic injury disaster loan that was made between January 31 and April 3rd of this year. When we initially saw the legislation, there was a misconception, or at least some people had a misconception that if you applied for a PPP, you could not also have an EIDL and vice versa. In fact, we understand now that you can obtain loans under both programs, but you can't use them for the same purposes. And so if you obtain an EIDL and you use the proceeds to pay payroll, for example, you have to refinance that into your PPP loan, which frankly is a sort of a better deal anyway, because the PPP loans, as we'll talk about, have a forgiveness aspect to them that the EIDL loans do not. Next slide, please. So I think, just the legislation itself had mentioned or had suggested that PPP loans could be used potentially for other things that are allowable under the SBA rules generally. But both the SBA's rule as to this program, as well as the borrower application form, are very clear that the loan proceeds may only be used for these specified purposes, whether or not you're anticipating forgiveness. So even if you're not concerned about your forgiveness amount, you still can only use these loans for very limited purposes. Next slide, please. At least 75% of the loan proceeds have to be used for payroll costs, or to put it another way, no more than 25% of the proceeds can be used for things like mortgage interest, rent, and utilities. Next slide. Borrowers are subject to penalties for knowingly misusing the loan funds, and perhaps more significantly, the SBA published a response to a frequently asked question yesterday that said that certain well-capitalized businesses may not be eligible for loans. This was, I think, largely in response to, there were some past days that some very large restaurant chains and some even publicly traded companies had been able to obtain loans under this program. The program, as many of you probably know, was intended for businesses with 500 or fewer employees, with only certain exceptions. And so I think there was, some real sort of outrage about the fact that large, well-capitalized, publicly traded companies were benefiting from loans intended for small businesses. And so what the SBA says is that if you are, they give the example of a publicly traded company, and they say, look, if you're a publicly traded company with access to, public capital markets, and perhaps even in certain other instances, you cannot apply, or you are not eligible for one of these loans because you essentially cannot fill out the certification in good faith, which says that these funds are needed for you to maintain operations if you have, multiple other sources of funds. They do include a safe harbor that indicates that businesses that think they might, fall into that category will not be penalized if they repay their loans by May 7th. So next few slides, we're going to be talking about how much of a loan is eligible for forgiveness. And there have been a lot of questions about this particular topic. We are still awaiting guidance on a number of these issues. So, I'll talk a little bit about that as they come up in the slides. But, in theory, the entire amount of a PPP loan and all of the accrued interest is eligible for forgiveness, provided that you spend it in the covered period. The covered period here is the 8-week period that begins the date the loan is dispersed. So you have 8 weeks within which to spend the entire loan amount on qualified expenses if you want the full amount forgiven. And then the statute makes clear that the forgiveness amount is excluded from gross income. So, the typical rule is that if you have a debt forgiven, there's typically cancellation of debt income. Here, that is not the case. So it really is, it really truly is free money for borrowers who are able to qualify in full for forgiveness. Let's move to the next slide, please. So again, this is a similar, although not quite identical list of items that will qualify for forgiveness if incurred and paid during the covered period. So payroll costs. Payroll costs here include not only cash payments that you make to employees, but also items like contributions to employees' 401ks, contributions to employees' health insurance or health insurance premiums, state unemployment insurance obligations. There's a couple of nuances here. I would say one is that, and it's almost obvious, but one is that you can't double count. So for example, if an employee makes an elective deferral of $5,000 to his or her 401k, that amount gets taken into account as part of the employee's wages. You can't then count it a second time as a retirement contribution. Some of the other items are payments of mortgage interest on mortgages incurred before February 15, rent payments under leases entered into before February 15, and utility payments under utility service agreements entered into before February 15. The interesting thing to note here is that these are all just a little bit narrower than how the comparable items are defined when the statute talks about what you can use the proceeds for. So for example, if you receive a PPP loan and you use it to pay interest on a loan, or use it to pay rent on a lease that was entered into after February 15th, that's an allowable use of the proceeds, but it is not going to be forgivable. Next slide, please. And then let me just pause for a second. Suhas, I think if you don't mind me putting you on the spot, I think you and I talked a bit yesterday about potentially how that phrase cost incurred and payments made during the covered period might be interpreted in the context of payroll costs and wages. Did you want to talk just a little bit to that?
Sure. And might take a few minutes, but okay. So the concept of loan forgiveness has introduced this terminology where the costs, the Act says that the costs incurred and payments made during the covered period are eligible for forgiveness. So this concept of incurred and payments, which makes it very difficult because it's very confusing and vague terminology, because we all know that during that 8-week period, it is possible that a business may incur an expense, but it may be not paid in that period. Then the question is, what would be considered qualifying cost? Because the terminology is so confusing, our guidance is as follows, okay? And I'll give you an example that would make it very easy, okay? So let's say a company got its loan on April 12th, on April 13th, and then they processed the payroll on April 15th. The payroll for the week was processed on April 15th. It straddles period before April 13th and a period after April 13th. So in that case, only a portion of the payroll, which is from April 13th through April 18th would be counted. On the back end of the covered period, which is when the 8 weeks end, again the payroll will straddle the last day of the 8 weeks. And our guidance is that when that happens, if you have a short, we would request employers to process a short period payroll that ends on the last day of the 8th week. That by following that procedure, you have you are respectful of not only incurred, but you also paid. So you also incurred the cost and you also paid in that 8-week cover period. Similarly, in case of rent, also it's possible that the rent might straddle the beginning period, then only the period that covers from the date of your loan to should be counted. But on the back end, we would request that you prepay the rent, but when you calculate the forgiveness, only take into consideration the period that ends on the last day of the 8th week. This way, you have satisfied the requirement of incurred and paid. It is very important to understand that the concept here is incurred and paid, not incurred or paid. So in order to satisfy that requirement, we request that employers pay, don't prepay, but pay all the incurred costs within that 8-week period to qualify.
Right, and so I think, to that point, I mean, there had been some questions, for example, about if you couldn't get to if you sort of couldn't get to the full number, could you perhaps prepay rent? Could you pay July or August rent during the 8-week covered period in order to increase your forgiveness amount? And while we don't necessarily have definitive guidance on that, I think that your reading of the statute makes a lot of sense, and I would be very reluctant to recommend that somebody do that because of the issue that rent, while it might be paid during the period, really was not incurred during the period.
Right. So if they can prepay it, but in their calculation of forgiveness, they should count only the period that covers 8 weeks.
Correct. Or at least we think it's correct. We're still waiting for more guidance.
Right now, that's the most conservative guidance I can give because there is no guidance,
Right. And then the other thing, and I mentioned this earlier with respect to how the proceeds can be used, but there is also this 75% requirement, which the SBA has said is consistent with the purpose of the statute to keep people employed and on payrolls and prevent them from, sort of further overwhelming the state unemployment systems, is that you have to spend at least 75% of the forgiveness amount on eligible payroll costs. Payroll costs, incidentally, they include cash wages to employees, but only to the extent of $100,000 per year on a prorated basis for that 8-week period. So what that means effectively is that you cannot pay a single employee more than $15,385 during that 8-week period, or at least if you do, it won't be counted as a payroll cost for purposes of how to use the loan proceeds and whether they're forgivable. I've heard, I don't know, John Paul or Suhas, if you've heard this, but I've heard a couple clients suggest that, well, if we're falling short, maybe we could just make it up by, bonusing out money to certain employees. And while that might work in certain instances, I don't think it's going to work if you've got employees that are at or over that threshold.
Right. And Ivan, I think the other question I've gotten, and I'm just curious on your thoughts and Suhas's thoughts. Many companies cut payroll earlier before the start of the program. So one of the questions was, if you have additional funds, can you catch up those employees for the period prior to the start of the program? My sense is not, but I'm curious what else we've heard on that question.
So
go ahead.
No, so I agree with you because then you had given a payroll cut to people, and now you're paying within that 8-week period and say it is incurred. I believe that's not how the system was set up. Again, taking a conservative approach of paid and incurred definition, that the amount that you're paying in 8 weeks to catch up was not really incurred in that period,
Agreed.
Right. My idea,
that's my reading.
And I can't. Yeah, my idea that I suggested to a couple people, and again, I don't know whether this would necessarily work, but rather than paying people for a prior period where you really have no obligation to them would be if you want to sort of do the right thing by certain employees, and where you need, and if you feel that you need to spend more to use the funds, maybe you can kind of characterize it a different way as a retention bonus or a re-signing bonus, something like that, as opposed to saying, here's pay for a prior period when you were furloughed or when you were unemployed that you have no obligation to pay. It seems to me that it may be possible to do it, but it maybe should be characterized in a slightly different way to make it hopefully pass muster.
What I have seen, this is Suhas, what I have seen is that employers have given 20% pay cut before the PPP loan was received. And once they received the PPP loan, they have restored the payroll to the regular 100% paycheck. And I think that is an acceptable use of funds.
Mm-hmm. Yeah, I would agree.
That is not a catch-up. That is not a catch-up. It is just restoring back the original pay rate, okay? Right.
And in fact, if we can move to the next slide, I think so the next several slides actually are going to speak a lot to this whole point of, are you eligible for forgiveness, and to what extent if you've either laid off employees or reduced employees' salaries. So there's kind of it's really just a math problem here, and it's a bit complicated. Although if you look at it for a while, it really isn't too terribly complicated. But basically, the statute says that your forgiveness amount is going to be reduced by multiplying the forgiveness amount by a fraction. The numerator is the average number of full-time equivalent employees during the covered period, which again is going to be that 8-week period starting the day you get the loan. And the denominator is either it's the number of full-time equivalent employees that you employ between February 15 and June 30, or it's the average number of full-time equivalent employees during the first 2 months of 2020. So to take a simple example, suppose you had 90 full-time equivalent employees during the covered period, and you had 100 during the testing period, and your loan forgiveness amount was otherwise $1 million. You would take that $1 million and multiply it by that fraction, 90 over 100, and now your forgiveness amount is reduced. Instead of $1 million, it's $900,000. And I'll talk about in just a second. There's also an exception to that exception. If we could move to the next slide, though, I want to talk first about there's also a reduction in forgiveness amount for significant reductions in salary or wages paid to certain employees. And specifically, if you reduce the salary of an employee who earned $100,000 or less by more than 25%, your forgiveness amount is going to be reduced by an amount to the extent that it exceeds that 25% reduction. I give an example in the second slide, although I do want to alert people. I realize there's a mistake in this bullet point, which is that I neglected to sort of prorate it for the covered period. So consider you have an employee who was paid $100,000 in 2019. You reduce this employee's pay by 40% or $40,000, and then during the covered period, your forgiveness would be reduced. I say here 15,000. I believe the correct it's actually 8/52 of that, or the amount that occurs during the covered period. So instead of 15,000, it's about a $2,300 reduction. So it's typically not a huge reduction, but it is something to bear in mind if you've cut the salaries of employees by too significant an amount. And again, this per se reduction does not apply if the reductions are to employees who are making more than 100,000, or if it's less than 25%. You may have seen, I know I've seen in the news articles about, companies that have, reduced executive pay very significantly in order to keep, low and moderate income workers employed. And that's completely allowable and won't prevent you from qualifying for full forgiveness. There's also, as I mentioned, there's an exception to the exception. If you either reduced your headcount or reduced the salaries of employees earning 100,000 or less by more than 25%, and then you eliminate those reductions by or on or before June 30, there is no reduction in forgiveness amount. The problem that you may have, however, when you do that, is just as a math exercise, if your payroll has been reduced too significantly, it may be difficult for you to pay the full amount in payroll during that 8-week period that you need to pay to achieve full forgiveness. As I mentioned earlier, you can't just make up for it by paying everyone a huge bonus, even if you'd like to, because everyone's going to be capped at that 15,385 number.
So Ivan, just to build on that, a little bit of question for you. So if you add these employees before June 30th, that alone isn't enough to get the full forgiveness, right? You have to have spent the same amount of money as if you had those employees at the time, correct?
Exactly right. Because the forgiveness amount, as we talked about earlier, it's always going to be based on, the costs incurred and the payments actually made during the covered period. So if you say, well, yes, I had a layoff event, but then I brought everyone back on June 29, the response is going to be, okay, great, you qualify for full forgiveness, but your forgiveness amount still is going to equal, only the amount of, qualified payroll plus other covered expenses during that covered period.
Right.
So, and it is interesting. I mean, I've talked to a number of people who had that exact question or had that exact misimpression where they said, well, yeah, we did have a reduction in force, unfortunately, and we'd love to bring everybody back, but why don't we wait to do it until June 29 or June 30? Isn't that really what our incentive is? And I said, well, not really, because you may not have enough payroll to pay the full amount. And then at the end of the day, you have a loan that you've got to repay. Now, I will say, some people may say, having a loan that you've got a couple of years to repay at 1% may not be the end of the world, but if you can get forgiveness, sort of all else being equal, that's an even better deal. So let's talk for a minute about how you get loan forgiveness. So the SBA has said that there's, basically you're going to have to submit an application and you're going to have to submit documents that verify the number of full-time employees that were on your payroll and the amounts you paid them for the covered period. It's going to include things like your payroll tax filings, the 941s, your equivalent state income, payroll, and unemployment filings, and then proof that you actually paid the money, like canceled checks, bank statements, things like that, rent statements, mortgage interest statements, etc. If we can go to the next slide, please. And then you're also going to need, as with any loan or any legal document, you're going to need, certification from the borrower that the information you're providing is true and accurate, and that the amounts for which you're requesting forgiveness were in fact used to retain employees and for other covered purposes. And then it says, right in the SBA guidance that you have to submit any other documentation required by the SBA or the lender. I'm interested to ask John Paul and Suhas, have either of you have any banks put their applications together yet or given any insights into what they'll require? Because I personally have not seen that. The only thing I've heard anecdotally is that the banks are sort of, they vary in what they're asking for.
Go ahead, John Paul, and I'll talk. You go ahead first.
Okay. Yeah, I've heard no specifics, and it's an area that we get a lot of questions about, frankly. And I think it's because there isn't much guidance. And one of the questions that I think comes up on the forgiveness piece is, since we don't know exactly what banks will require, what tips and strategies can we give borrowers to help maximize their potential for forgiveness? And I know one of the things a few clients have talked to me about is segregating the funds when you get them. In a segregated account, use that account to pay payroll, pay rent, pay utilities. So depending on what the SBA eventually asks for, you have a very clear sort of follow the money trail to prove sort of what expenses you use, so you can verify your eligibility for the forgiveness.
Now, I have also heard guidance, and I don't know how practical it is that when employers are processing their payroll, and if you're processing a payroll of an employee that makes over 100,000, then they may have to fund their payroll, a portion of it from the segregated funds and a portion from their regular funds. I don't know whether you heard that or not, but I'm hearing those kind of noises too,
I have not heard that, but it would certainly make sense to me, because again, you really can't. It seems to me that the way that I read the statute is that not only are you not allowed to seek forgiveness for amounts in excess of that limit, but you're not even. It doesn't even count as a payroll cost in the first place. So it would seem like
exactly. Exactly. And
so,
mm-hmm.
Can you speak to that question though that John Paul had? Because I think, given your expertise, I think this is maybe more sort of your area. What can borrowers do to present sort of the cleanest possible trail for the bank to go, listen,
right.
Here's exactly how we use the funds. They were all qualified, et cetera.
Right. So, like everybody on the panel is saying, there is very little bit guidance, and guidance is very vague. So, we have chosen to advise our clients to take a conservative approach. And what I mean by that is absolutely segregate the funds, keep the PPP loan funds in a separate account. Okay. And then every time when you are incurring qualified expenses, only the qualified expenses, to that extent, money should be disbursed out of that special account. Okay, that is one thing. Also, not game the system. Try to prepay what you are not qualified to. Don't pay expenses that would otherwise qualify, but they are outside the period. Do not pay those expenses. Also, we are telling our client base to start creating spreadsheets. In fact, our firm has developed a spreadsheet that we are asking our clients to start filling it out week by week, so they can start tracking amount that qualifies, and they are not caught by surprise at the end, and are ready to apply for the forgiveness in a timely manner. That's the only guidance I can give you. And one last thing I would still say, people have ideas of gaming the system. I think ultimately when everything settles down, there are going to be audits, and there will be agencies that will start looking under the hood. And so an innocent mistake is okay, but a deliberate, intentional gaming of the system is going to be really looked down upon.
Right. Well, and we've seen already, I don't know that I would call it a gaming of the system, because it appears that they were permitted by the terms of the program, but we've already seen, as I think I mentioned earlier, there have been a couple, very large, even publicly traded companies that have managed to apply for and obtain these loans, and they've, I think in all but maybe one or two instances, or maybe all instances now, they've essentially been, publicly shamed into paying the money back.
Right. No, you're right. The gaming of the system might be wrong term, but what I'm saying is, if you end up paying for whole year's rent within 8 weeks, that's going to be looked down upon. That's going to be rejected.
Right.
I mean, if you pay the whole year rent, the whole year of rent, if you pay in 2 months, that's
Right. and I think that's where we're going to come back to the purpose of this statute, which really seems to be to keep people employed during an acute crisis. I'm frankly interested to see. You know, I'm sitting here in Illinois. We just yesterday, our governor extended the shelter in place through May 30, and I sort of wonder whether we might see at some point an expansion of these loan terms, because it may be that for many businesses, you know, think of the retail businesses or you know, restaurants, June 30 may not be long enough to allow their business to recover.
Ivan, I have a question, and the question relates to what if an employer has a discretionary profit sharing plan, and if they contribute to their discretionary profit sharing plan. Normally, employer might be contributing at the end of the year, but in this case, what if an employer contributes to the profit sharing plan within this 8-week period? Would it be considered a qualified expense? Do you know if there's any guidance about that?
I have not seen that. I will say that what I have looked into, and there's also no guidance as to this question, is what if you make like a mid-year contribution to a 401k plan, for example, and there's all kinds of issues that come up there. One is that some of the plans themselves don't necessarily allow for mid-year contributions. So you have to make sure that your plan documents permit it. But then even if they do, you know, that you could have questions about vesting and if the money will ultimately be returned to an employee or to the employer rather, does that count as a valid contribution? So yeah, there's a lot of issues there, and unfortunately, not a lot of guidance presently.
But I suspect that because all these questions are popping up, that within these next 8 weeks there'll be further guidance that will be, you know, issued. You know, they will have to, you know.
I agree. Are we able to? Let's move to the next slide, please. I'm sorry, go back one. Okay, so just to finish this discussion about how the forgiveness is going to work, lenders who receive an application are going to have 60 days within which to issue a decision. I'm not aware of there being any deadline for a borrower to submit its forgiveness application, but you know, typically you would think that best practice would be to submit it as soon as possible. Obviously, you have to wait at least until the end of the 8-week period when you know how much you paid out and what your full-time equivalent employment was and so forth. But you know, it would make sense, I would think, in almost every case for borrowers to submit the documentation and the application as soon as possible when they have all the information before them and sort of hasn't been an opportunity for anything to get lost or confused or what have you. And then, of course, just wanting the certainty of knowing that their forgiveness application will be accepted and what's the amount that they're actually going to have to repay. And then I think, you know, the last few relate to what will happen to any loan balance that is not forgiven. And the result there is, can we move forward, please? So loan proceeds, as I think I said earlier, loan proceeds that don't qualify for forgiveness have to be repaid over 2 years at the rate of 1% interest. Borrowers are not required to make any payments of principal or interest for 6 months from the date that the loan is dispersed. Interest continues to accrue during that time, and so as a result, you'll have, to the extent there is any balance due that has to be repaid, you'll have 18 months within which to repay interest and principal.
So Ivan, can I just add one more wrinkle to this PPP loan and the definition of compensation?
Yes, of course.
So, for the purposes of PPP loan and forgiveness program, payroll costs, like you explained in the earlier slide, consists of compensation paid to the employees, payment for vacations and sick leave and severance payments and group health insurance, contributions to the retirement plan, and state unemployment taxes. One of the questions that came up was, what does the act mean by compensation? Okay, and there are some people are not very at least some of our clients were not very clear whether that compensation meant Social Security wages, taxable wages, or Medicare wages. So we researched more into it, and I also looked up the FAQs that were issued, and after reading through the footnote on below question 21 of the FAQ, we have come to the conclusion that compensation for the purposes of payroll cost here means the gross compensation, which is neither Social Security wages, nor taxable wages, nor Medicare wages. To give you, it is the gross compensation that an employer pays. So to give you an example, if an employer pays $1,000 to an employee for a week, and from that $1,000, $100 are taken out for Section 125 employee share of healthcare cost, and another $100 are taken out because employee has decided to contribute to 401k, employee share of 401k. So in this instance, the taxable wages are going to be $800. Okay, Social Security and Medicare wages are going to be $900. Okay, but for the purpose of PPP loan and loan forgiveness, I believe compensation that has to be taken into consideration would still be $1,000, and that is kind of in a very direct or indirect way confirmed by the footnote on the Paycheck Protection Loan Program FAQ. This note is under question 21.
Suhas, a question for you on that. What about additional costs beyond the $1,000 that the employer pays?
Yeah,
Those
so
would not
that's
be included, would it?
Yeah, so that's already in the definition of payroll cost. I was defining compensation. Beyond the compensation that I defined, the way I defined it, you would also include the group health insurance cost that the employer pays, the qualified retirement contribution that the employer is making, and employer share of state unemployment taxes.
Okay, great.
But I wanted to be very clear as to what is the definition of compensation. Is just one of the elements of the payroll cost, and I wanted to be clear as to what that compensation means.
Got it. Yeah, thank you.
But John, did I answer your question about what you asked me?
Yes, you did. Thank you, Suhas.
Evan, that was my
Yeah.
that was the last.
Yeah, and I think it looks like this last slide says payment concept of incurred and payments made, and I think we talked about that. We sort of incorporated it earlier, so I think we've already covered that.
Because what I want to make sure is people understand not only the expenses have to be incurred, but they have to be paid within 8 weeks. And
right,
the way I explained it is the way you can, Now, I'm not sure that is going to work in case of union companies, whether union companies can truncate their payroll in the last week of the 8 week. I don't know about the answer to, because unions are very strict about how the payroll should be processed for their union members, okay?
Right. Well, I think, as you can see, that's sort of the end of our prepared remarks. I think we have a few minutes left, and we'd certainly be happy to field any questions. I don't know if we have any that have been submitted either through the chat function or otherwise, but
oh boy, yeah, we got a whole bunch of questions that have come in here. So first and foremost, thank you everybody. I know we won't be able to get to probably all these questions right now. Yeah, we have quite a few that have come through here, but I'm looking through a couple of them here. We'll probably try and avoid some of the more specific ones, and I know all of you guys can look back and see all of this presentation in the recorded email. So take a look out for your email. You can review some of those things, and as you can see on your screen, these are some really good resources here. For some of those more specific questions that you may not, that you may not be able to get in here at this time too. So maybe we can start off with this question. Since we were just recently talking about unions, oh, we lost it here too. Well, I guess first and foremost, Suhas, they were asking. A couple of people have been asking the copy of the spreadsheet to track those expenses. What do you recommend is on that spreadsheet? If they're building out a template, they're putting some things together for that spreadsheet. What would you say would be some good pieces to start? What kind of guidance would you give to people to prepare that?
So our spreadsheet like starts with it has a lot of tabs in it, but the tab starts with what is your beginning date of the loan, what is the ending date of your loan when the forgiveness kicks in, and then there are tabs for each week for the payroll and for other qualifying costs, along with the information about the check numbers or EFT numbers to kind of track it on a week-to-week basis. Okay. So, if you want to, we can share our spreadsheet with you, and we can send it to Foundation Software or to Han Lozier, and people, employers or participants can use it. But again, we don't take the responsibility for it. Ultimately, you have to discuss with your consultants to make sure that the spreadsheet is working the way it's supposed to work. And I'm not taking the responsibility for any errors in them, but we are using it for our own clients,
Absolutely.
But it is almost like a workbook, it is, because you have to accommodate in that spreadsheet the full-time employees, part-time employees, what has to be counted for union employees versus non-union, companies that are not non-union. And also there are tabs to calculate the a portion of forgiveness that would be reduced because of the head count or because of the salary count. So it's a pretty comprehensive spreadsheet.
Cool. So a couple of questions, and I'll leave this kind of open to you guys, to the panelists here, to kind of just maybe expand on this as a whole, because I see a handful of questions and they're all in different specifics. So in regards to hazard pay and this PPP, what is some guidance that you can maybe give to applying hazard pay and it being forgiven and some of these additional details? Just maybe expand on that thought as a whole, if you could. Maybe John Paul, anyone? You guys.
I don't think that this is something that is necessarily addressed in the existing guidance. I think it probably comes closest to, when we talked earlier about whether a cost is truly incurred, during the covered period. And, if an employer is making a payment that it's not obligated to, on the one hand, you might say that won't or shouldn't qualify. On the other hand, and it may vary a lot depending on sort of industry or circumstance, but, if an employer feels that payment is necessary to retain its workforce, and to, keep employees on the payroll and keep jobs moving and so forth, I would imagine that that's not something that, the SBA or the banks are going to be second guessing too much, so long as it isn't, egregious or doesn't appear abusive.
I would agree with you.
I completely agree with you. I completely agree with you.
One of the challenges here is this statute and the provisions and the guidance come out so fast that you look every day and there's new information. So, can we say definitively there's an answer on that? No, but I think Ivan and Suhas's advice is spot on.
So another question here too, it's similar. We've gotten this question in maybe kind of a handful of different flavors, but again, if you can kind of generically speak to full-time employees, I know a lot of people out there having some questions as far as what exactly is counted as a full-time employee, some hours provisions, EPSLA, all these other pieces and parts that kind of go into tracking, the EFMLA employees and so forth, if they're on those types of programs, depending on the hours they're working and so forth. Is there any way you can guys give a little bit more clarity to, what kind of full-time employees, what goes into what's calculated and counted into this? Ivan, we'll start with Ivan, maybe. That's probably easiest.
Yeah, I think this one is relatively straightforward. I think that, so there's another provision of the CARES Act, which was the huge, $2.2 trillion stimulus. And there's another provision of that essentially says that when you're computing average full-time employment, at least for some purposes, it makes reference to a particular IRS test, which essentially treats 30 hours as being full-time. And so what you would do is, if an employee is working 30 or more hours in a week, they're considered, one full-time. And then anybody who's working less than 30, you add up their hours and you divide by 120 hours for the month, which obviously sort of approximates 30 per week. So if you had 2 employees each working 15 hours in a week, they would add up to 1 FTE. I don't know that it's exactly 100% clear that that's the test you're supposed to apply for this purpose, but I think given that it's in the CARES Act, I think that's the assumption that most people are making, and I've seen, a lot of sort of guidance to that effect that's the test to use.
Cool. And maybe we'll limit it to another 1 or 2 here. But again, thank you everybody for all these questions. I know there's a ton of them. We'll try and get to the questions that are kind of most helpful to the group as a whole, or we're trying to get to the ones that we can see for anything. So what we've seen a lot is around this $100,000 limit. We've gotten a number of questions here as far as if they're over, can you compensate them back to get them to get them back to their original wages? Is what all is included in that 100,000? Is there additional items outside of just simply salary that need to be included in the wages in that $100,000 limit? If maybe we could just expand on that $100,000 limit seems to be something people are asking about as a whole.
So Ivan, maybe let me take a stab at it, and if you can correct me if I'm wrong, okay? But from what I've read through, this 100,000 is that limit of 100,000 applies to compensation element of the payroll cost. So if somebody's salary is this 100,000 limit does not, we are not supposed to take into consideration the insurance cost and the retirement benefits. It's pure salary component of it that is taken into account for the $100,000 or $8,333 per month. Am I correct?
That is correct. At least certainly as far as I know, that you take a prorated 100,000 and that is that's what and it counts, as you said, toward cash compensation. So exactly. Other amounts like the employer's contributions to other items like healthcare, like 401k, et cetera, shouldn't come into it. Those are taken into account in addition to what they refer to as cash compensation. Exactly. I will say that, in general, when businesses apply for loans, the amount of their loan is only taking into account employee payroll up to $100,000 per employee. So if everything remained exactly static, the amount of the loan would be exactly enough to pay everybody earning up to 100,000, and then everybody earning exactly at 100,000. The reason it becomes complicated is because, of course, things aren't exactly static. You have some employers that may have a loan amount that's based on a higher payroll than what they have currently, and then of course because it's 2.5 times payroll, there's a little bit of extra money, and if you don't have the rent expense or you don't have the mortgage expense to sort of use the full amount, that's where you can get into these questions about, well, can I pay somebody, you know, over 100,000 using PPP funds? And I think, unfortunately, the answer to that is no.
No.
Well, that's been great, you guys. Just as a whole, you know, I'd like to thank everyone for participating. We had a great turnout. I know this was a fairly quick turnaround here, but you know, we're working really hard. Han Lozier, as well as Intellis with Suhas and everyone here, they put a great job together to help Foundation Software bring you guys, you know, some relevant information. We know everything's super timely right now. Everything's changing really quickly. You know, as Ivan mentioned, you know, some of those pieces of the slide changed as of, you know, last evening, and things are moving very quickly. So we appreciate everyone being able to jump in so quickly. But you know, we do have two really good presentations similar to this one coming up for you at 1 o'clock Eastern Standard, and that'll be on April 29th and May 6th. We'll be covering a couple of different topics, but in the meantime, you know, you see everybody's information on the screen. I know it's a little confusing with the identifiers on there on the actual webcams, but you got Suhas's information, you got John Paul's, you got Ivan's. Everybody's information is up there. You know, you'll see in the follow-up email the recording, and I think you guys, John Paul, you guys can correct me if I'm wrong, but I think you guys will be providing a little bit of a benefit for everybody joining here. John Paul, Ivan, I think you guys, I think there's a consultation or something along those lines that you guys are going to be providing for participants in today's webinar.
Correct. Yes.
Yes. Yeah. So you'll see it. Sorry, I should have specified. I'm giving two people at one time, but hey, so you guys will see the details of that. Like I said, thank you to all of the partners who kind of came together to make this work today. You'll see in the follow-up email some additional benefits and ways that, you know, everyone's trying to help out all of our participants of the webinar today. But other than that, thank you guys. Thank you, everybody. And hopefully we'll see you guys next week on Wednesday at 1 o'clock. So thanks.
And Eric, if any participant wants to get the spreadsheet that we have the workbook that we are developing and continuing to develop, my email address is there, and you know, they can reach out to me. Okay.
Sure, and you know what, we have in that follow-up email, let's see, maybe Suhas will see if we can include that in that email. The timing will be a little tough.
Sure.
We got that pretty primed up. So if we aren't able to include that in the follow-up email, you guys can feel free to reach out to Suhas with his information on the screen here. And look forward to talking to you guys again soon. And thanks for joining today. So thanks, everybody.
Thanks, everyone.
And thank you, everybody. Thank you to Foundation for providing us the opportunity.
Yep.
Thank you.
Yeah, thank you, Eric.
Thank you very much.
Thanks, guys. Take care.